All right, index funds, mutual funds, hedge funds, or ETFs. I am sure you've heard about these before. You've probably watched the videos, heard influencers say things like, just throw your money into an index fund, but if you're honest, you're not 100% sure what they all are or how they're different. So please give me the next few minutes and I'll give you the knowledge most people take years to figure out. In this video, I'm going to explain these types of investments in a super simple and practical way. We'll start with what a fund actually is, then go over the different kinds, the strategies they use, the hidden fees, and most importantly, who they're really meant for. By the end, you'll have the clarity to invest with confidence. But first of all, I would like to make clear that this is not any kind of financial advice. All right, let's get into it. Section 1. What is a fund? Before diving into every kind of fund, first, let's understand what a fund actually is. Imagine you and your friends want to buy something expensive, like a big pizza deal. One person can't pay for everything, so everyone throws in a few dollars. When you combine all that money, suddenly you can afford a huge pizza, drinks, sides, way more than any one person could buy alone. That's exactly what a fund does. Thousands of investors put their money into one big pool. A professional manager then uses that pool to buy lots of different investments, hundreds or even thousands of stocks and bonds at the same time. When you invest in the fund, you get a small slice of that entire basket. And the biggest advantage? Instant diversification. If one company performs poorly, it hardly affects you because it's just one tiny piece of a very large mix. Your risk is spread out automatically. This simple idea of pooling money together is the foundation for everything else we're going to talk about. Section 2. The two strategies, active versus passive. Before we talk about the different kinds of funds, you need to understand the mindset behind them. This one idea, active versus passive, explains why some funds cost more, why some perform better, and why most investors struggle. Let's break it down in the simplest way. Active investing, the prediction game. Active investing is like hiring a professional driver for a road trip. This driver says, I know the best shortcuts, the hidden roads, and the fastest roads. Trust me, I can get you there quicker than everyone else. So the driver constantly changes lanes, switches routes, speeds up, slows down, trying to beat all the other cars on the road, the market. But here's the catch. Professional drivers are expensive, and sometimes even with all the fancy moves, traffic jam, they don't end up reaching any faster. That's active investing. Managers try to outsmart the market, they buy and sell constantly, they charge higher fees, and most of the time, their predictions fall short. Passive investing, the follow the map strategy. Passive investing is much simpler. Imagine you're using Google Maps on a normal route everyone takes. No shortcuts, no tricks. Just a clean, proven path that reliably gets you from point A to point B. That's passive investing. Instead of guessing the next hot stock, passive funds simply follow a map, a list of companies called an index. The S&P 500, big US companies, NASDAQ, tech companies, Dow Jones, industrial giants. A passive fund doesn't try to beat the market, it just tries to match it. And because nobody's trying clever shortcuts, fees are extremely low, mistakes are minimal, results are consistent long-term. So who wins, the shortcut driver or the Google Maps route? Here's where it gets interesting. In 2007, Warren Buffett made a legendary bet. He said, a simple, low-cost S&P 500 index fund will beat a group of expensive hedge funds over 10 years. Hedge funds had elite managers, complex strategies, sky-high fees, and teams of analysts Buffett's pick, one cheap index fund following the S&P 500. 10 years later, the results came in. The hedge funds, about 2.2% SAR per year. After fees, the simple index fund over 7.1%. Per year, Buffett won easily, and his point was clear. You don't need to be smarter than the market. You just need to stop paying people who try to be smarter than the market. For most people, the simple route wins every single time. Section 3, the main event, mutual funds versus ETFs. Now let's talk about two of the most popular investing tools in the world, mutual funds and ETFs. At first glance, they look almost identical. Both give you diversification, both hold a mix of stocks or bonds, and both can follow the same index. But the real difference isn't what they invest in, it's how you buy them. Let's make this super simple. Mutual funds, the end of the day purchase. Think of a mutual fund like ordering a custom meal at a slow cooker restaurant. You can place your order anytime during the day, but the kitchen only serves once, at night after closing. So whether you order at 9 a.m. or 3 p.m., your meal, your buy-sell order, is prepared at one single price, calculated after the market closes. That final price is called NAV, net asset value. If you order before the daily cutoff, you get today's NAV. If you miss it, your order fills the next day. Mutual funds are great for automatic monthly investments, retirement accounts, long-term set-it-and-forget-it investing, but they often come with minimum investment requirements like $1,000 or even $3,000 just to get started. ETFs, the shop whenever you want option. Now think of an ETF like grabbing something off the shelf at a supermarket. It's already made, it's ready to go, and the price changes all day based on supply and demand. ETFs trade on the stock market like shares of Apple or Tesla. You can buy anytime, sell anytime, see the price move in real time, buy just one share, buy fractional shares on many platforms. This flexibility makes ETFs extremely beginner-friendly. Same diversification as mutual funds, but with the freedom of a stock. So, what's the real difference? Trading. Mutual funds trade once per day. ETFs trade all day long. Pricing. Mutual funds, one closing price, NAV. ETFs, constantly changing prices. Accessibility. Mutual funds often have high minimums. ETFs, buy one share or even less. In the end, mutual funds and ETFs often hold the same investments. You're just choosing how you want to buy them. Slow cooker restaurant or supermarket shelf. Both can be great, just depends on your style. Section 4, putting it all together, the index fund idea. Before we go any further, let's clear up the single biggest misunderstanding people have. Index fund is a strategy, not a container. It doesn't describe how the investment is packaged. It describes what the investment is trying to do. An index fund is simply any fund, mutual fund, or ETF that follows an index passively. Its job is simple: copy the index. That's it. No guessing, no picking winners, no predicting the future. So you can have index mutual funds and index ETFs doing the exact same thing. Here's an easy example using the S&P 500 as the recipe. Vanguard 500 Index Fund, VFIAX. This is the mutual fund version. It tracks the S&P 500 and is priced once at the end of each day. Vanguard S&P 500 ETFVOO. This is the ETF version. It tracks the same S&P 500 index, but trades like a stock all day long. Same recipe, two different containers. The only real difference is how you prefer to buy it. Mutual fund, once per day, sometimes with minimums. ETF, buy any time during market hours, often with no minimums. Both are index funds, both are excellent choices. ETFs just happen to be a bit easier for beginners because you can start with even a single share or a fraction. Section 5, the other guy. What about hedge funds? Now let's talk about hedge fund, the mysterious, exclusive cousin in the investing world. Despite the name, hedge funds aren't really about hedging anymore. They're about taking big swings in the hope of achieving big returns. A hedge fund is a private investment pool where wealthy individuals and big institutions put in their money. These funds can use strategies that normal mutual funds and ETFs aren't allowed to use, such as short selling, betting a stock will fall, leverage, borrowing money to invest even more, complex trading strategies across multiple markets. These tools give hedge funds the ability to make massive profits and massive losses. That's why they're only open to accredited investors, people with a high income or high net worth. In simple terms, it's a rich people only club. And the fees, hedge funds are famous for the 2 and 20 model, 2% every year just for managing your money, 20% of any profits they make. It's expensive, very expensive. So for 99.9% of people, hedge funds don't matter. They're not accessible, not necessary, and not beginner friendly. But now you know what they are and why they're probably not part of your investing journey. Section 6, the hidden drain, fees, and taxes. This might be the least exciting section, but it's one of the most important. Because even if you pick the perfect investment, fees and taxes can quietly eat your returns from the inside. The difference between good growth and great growth often comes down to cost. The expense ratio, the silent cut. Every fund charges an annual fee called an expense ratio. You don't pay it directly. The fund just quietly deducts it from your returns. Here's the rule of thumb. Active funds, usually higher fees, 0.50% to 1% or more. Index funds and ETFs, ultra low fees, sometimes 0.03%. You might think, come on, that's less than 1%. What difference does it make? A huge difference. Let's say you invest $10,000 for 30 years at an average return of 8%. With a 1.03% fee, your money grows to $73,776. With a 0.03% fee, it grows to $97,896. That tiny little 1% quietly steals more than $24,000 from your future. This is why investors repeat one golden rule: low fees, higher long-term returns. Taxes. Why ETFs often come out ahead. Now, a quick but important tax insight. In a normal brokerage account, ETFs are often more tax efficient than mutual funds. Here's why. When many investors sell a mutual fund, the manager might sell stocks inside the fund to raise cash. Those sales can create capital gains taxes, and the fund may pass those taxes to all investors, even to people who didn't sell. ETFs, on the other hand, use a special in-kind mechanism that allows them to shuffle assets around without triggering those capital gains. Result? Mutual funds, more likely to create surprise tax bills. ETFs usually create fewer taxable events. For long-term investors, that difference adds up, and it's one more reason ETFs are incredibly beginner-friendly. Section 7, Common Mistakes and How to Avoid Them. You now understand the tools, the strategies, and the traps. Let's talk about the mistakes beginners make over and over and how you can avoid them from day one. Mistake 1, chasing last year's winners. A fund performs amazingly one year, and then suddenly everyone wants to buy it. But here's the truth. What went up fast often slows down fast. Don't jump into a fund just because it was the star performer last year. Build a long-term plan and stick to broad, low-cost index funds. Consistency beats excitement. Mistake 2, ignoring fees, the quiet killer. A 1% fee looks tiny until you see the math. Over decades, it can wipe out tens of thousands of dollars. Low cost is one of the strongest predictors of long-term success. Always check the expense ratio before you invest. Mistake 3, treating ETFs like trading toys. ETFs trade like stocks, so beginners feel the urge to buy and sell constantly, but trading too much usually leads to worse results. The right way? Buy your ETF, hold it, let time do the heavy lifting. Long-term patience beats short-term excitement every time. Mistake 4, fake diversification. Owning 5 different tech funds is not diversification. They all hold the same companies: Apple, Microsoft, Nvidia, etc. Real diversification means spreading your money across different asset classes, stocks and bonds, different regions, US and international. When one part of your portfolio struggles, another part can hold you steady. Section 8, your action plan, how to actually start. You've learned the concepts. Now let's make this real with a simple, practical action plan anyone can follow. Step 1, choose your account. Start by opening a brokerage account. Pick a trusted, low-cost company like Vanguard, Fidelity, Charles Schwab. These platforms make investing easy, cheap, and beginner-friendly. If you can open a bank account, you can open a brokerage account. Step 2, choose your strategy. For most beginners, the smartest path is passive index investing. It's simple, low stress, and historically beats most active investors. A great starting point is owning 2 things: US stocks, international stocks. Together, they give you exposure to almost the entire world's markets. Step 3, choose your funds. With just 2 or 3 ETFs, you can build a globally diversified professional-level portfolio. Here's a clean starting lineup. VTI, Total US Stock Market ETF, owns the entire US market. Expense ratio, approximately 0.03%. VXUS, Total International Stock ETF, owns thousands of companies outside the US expense ratio, approximately 0.05%. Optional BND, Total Bond Market ETF, adds stability, especially if you want less volatility. That's it. A simple, powerful portfolio used by millions of successful long-term investors. Step 4, automate everything. This is the secret sauce. Set up automatic, recurring investments weekly, bi-weekly, or monthly. Automation removes emotion. It makes you invest during good times and bad times, which is exactly how wealth grows. Your job becomes unbelievably simple. Put money in consistently and stay invested. Conclusion. That's everything you need to know. For most everyday investors, index funds or ETFs are the best choice. Low cost, easy to understand, broadly diversified, perfect for long-term growth. Mutual funds can work if you trust a specific manager. Just keep higher fees in mind. Hedge funds, they're really only for wealthy investors who are comfortable taking bigger risks. The truth is, successful investing isn't complicated. The formula is simple. Choose a low-cost, diversified index strategy, automate it, and let time do the work. You now have the knowledge to invest confidently. No guessing, no stress. Just a clear path forward. If this video helped you understand every kind of fund, I'd really appreciate it if you liked the video and subscribed. I'll leave a video here that you'll probably enjoy as well. Thanks for watching, and I'll see you soon.